Hello, everyone, and welcome to Money Matters with Doug Jones, the personal finance show designed to help you move forward financially. I'm Doug Jones, and today we're going to be talking about your credit score. What is a credit score? What factors go into affecting your credit score? How to maintain or improve your credit score? And joining us today is Julie Kuzmic, who's Director of Advocacy at Equifax Canada. Julie, welcome to the show.
Thanks so much.
I'm wondering if we could start off by having you tell us about Equifax and what you do.
Sure. So credit bureaus are often a bit misunderstood. There are two major credit bureaus in Canada, Equifax, and the other one is TransUnion. And the role of credit bureaus is to collect information from lenders and other entities that issue credit, like credit card issuers, for example, and then make that information available back, inapplicable with the regulations and the law, of course, to the lenders who may need that information to help them make their business decisions, like deciding whether or not to lend to a new applicant.
Okay. So one of the key things from an individual's point of view is if a person's checking on them, they're checking their credit score. And so can you explain to our viewers, what is a credit score?
Yeah, so very simple question, and it requires a bit of background. So as I mentioned, the credit bureaus are receiving this information typically on a monthly basis from most of the major lenders and credit issuers in Canada. What that's doing is it's landing on the credit file or credit report of each of us, the people in Canada who are using credit. So over time, the information on our credit files is getting more and more filled out every month that we are using our Visa card, our MasterCard, our car loan, our mortgage, all of those types of accounts. So that creates your credit report or credit file. Sometimes we refer to it that way. Sometimes you hear the term credit history. What a credit score is a snapshot of all the information that's in somebody's credit file at the time the score is calculated. So the credit score takes into account payment history and a number of other factors from the credit file, which I know we'll be diving into shortly. And it gives the lender a quick snapshot view of what kind of performance and where that consumer is standing right now, and gives them a bit of a prediction as to whether they are likely to pay their bills.
All right. So we've talked about the credit report, and then the credit report's information that's used to determine the credit score. So I think that one of the things I tell people all the time is to get a copy of the credit report. And the reason I ask them to get a copy of the credit report is to go through the categories and try to verify the information. So can you tell us a little bit more detail as to what a person would see in that credit report, and then correspondingly why that's so important for them to verify because of the effect it has on their score?
Yeah, I'm so happy to hear that you're giving that advice. A lot of the time people get very focused on credit scores. It's a number, it can be a little bit easier to think about, but really all the credit scores are based on the information in your credit file. And that's the data that you really want to be tracking to make sure that it's correct. So the vast majority of all that information is correct, but it can happen that somebody with a similar name and possibly a similar address, their information may appear on your credit file or vice versa. Or sometimes a bank or a lender makes a bit of a mistake in the data that they're sending. And so they're saying that you had a late payment when in fact you didn't. So these are all reasons that it's a great idea to check your own credit file just to make sure that everything is accurate and everything is there that should be. Everyone in Canada has the right to access their own credit report for free at any time. There's no limit to the number of times that you can access it. I mention that because in the States, there is a general concept of accessing credit files once a year, and it often gets misreported that everybody in Canada can do it once a year as well. It's actually anytime, so don't worry about the once a year thing. And you should be checking your credit file at both Equifax and TransUnion. You can do that for free at both of those two websites, just to make sure that the data, as I mentioned, is accurate. So let's dive into what is actually on your credit file.
Okay.
Let's do it. You're going to see the identification information, so your social insurance number, if we have it, your address, possibly some past addresses there. You're going to see a section called Inquiries. And this is actually an access log of every time somebody has accessed your credit history. And this is really important because everybody in Canada has a right to know who has accessed their credit history and for what purpose and when. And so we as a credit bureau have an obligation to record that on the credit file every time your credit is accessed. And the term we use for that is an inquiry. There are two categories of inquiries: hard inquiries and soft inquiries. And the main differences are hard inquiries are related to an actual application for credit. So you've gone and applied for a new Visa card, or you've applied for a car loan. Those are going to show up as hard inquiries on your credit file, and those are visible to anybody that you give permission to view your credit file. So when you apply for new credit, you have to give your consent. You have to give your permission for your credit file to be accessed, and they will be able to see those hard inquiries. The soft inquiries are anytime your credit file is accessed, but it's not for a purpose of applying for credit. One of the main categories here is when you are getting a copy of your own credit report. That is a soft inquiry. Soft inquiries are only visible to you as the person about whom all the information is on that credit file. So a lender is not going to see any soft inquiries, and soft inquiries never have any impact on credit scores. Hard inquiries can have an impact on credit scores. They don't always. And I know there's about 11 billion questions about hard inquiries alone on credit scores, and we'll dive into that in a bit. But just continuing with the other information on the credit report, we talked about how there's account information. So the balances, the amount of your last payment, the date that that account was opened. It's information like that that is on the credit file. And then the other section is called public records. And that's where information like a previous bankruptcy, if you've had an item that went into collections, even if it's been paid, it will still appear on the credit report for a period of 6 years, as well as any financially related legal judgments. So examples there would be something like unpaid taxes, where the Canada Revenue Agency has taken you to court over that, or potentially family support payments that haven't been made and a legal judgment has been rendered. So a little bit wordy, but that's the quick high level of what you'll see when you look at your credit report.
All right. So I think that what people need to understand is when they look at those categories, and so they check, their personal information, who they are, when they're born, where they live, where they work, look at the inquiries. And I'm glad you raised the point that soft inquiries don't affect their credit. Go through all that. If they find an error, they find something that's incorrect, it says that they were late on a payment, because I hear this all the time. People say to me, well, how do I fix it? Can you delve into the mechanisms to fix that?
Yeah, so there's a few important things to know. One is we want the most accurate available information on your credit report. So it is important to get it fixed, and we want to help get that information fixed. All the details about contacting Equifax is on the Equifax website at equifax.ca. It's a little bit different depending on the nature of the information that needs to be fixed. So you can see there whether you need to send in electronically some supporting documentation, or you can call the toll-free number and talk to an agent. But there's something I want people to understand about how this works. Let's say, for example, that somebody is in a consumer proposal, which I know would be something that's quite common in your line of work.
Correct.
And so in their consumer proposal, let's say that they have 8 accounts that are included in this proposal. And one of the lenders is reporting that account as being in a bankruptcy, not being in a consumer proposal. In that situation, you would want to call Equifax and let them know, and we would, of course, have the documentation from the proposal to be able to see, oh yeah, this is not in bankruptcy, it's in a proposal, and correct the information. But the next time that data gets reported by the lender, so the next month when they go through their standard reporting cycle, unless they change it on their side, it's going to get overwritten. That change that was made by the Equifax agent will get overwritten by the new data that is coming in from the lender. So while you're getting it corrected with the credit bureau, it's important to also be in touch with the lender and make sure that they are reporting it correctly so that you don't end up just back where you started with having it incorrect on your credit file.
That is a challenge that I see all the time, where people are calling to make the correction, but the lenders sometimes aren't as efficient, I'll say, at making those corrections, and it does become a bit of a back and forth. Okay, so can you explain to us fairly, what are the main factors to determine the score? So we verified all our information on the report. We want to get a good score. So what are the main things we should think about in the score?
So the most important factor is your payment history. Have you been making your payments on time? The second most important factor is what we call utilization, and that is what your balance is on an account, typically more on revolving accounts like a credit card or a line of credit, what your balance is relative to the credit limit. So lower balance will reflect better in a credit score calculation generally. The other factors involve the length of credit history, so how long, how much experience an individual has with credit. And we talked about the hard inquiries, so recent access of new credit counts for a small amount of the overall credit score. Those are the main factors that go into the calculation.
And I think that's one that a lot of people that I meet don't seem to understand, is that they've maxed out their credit. They make their minimum payments each month, and therefore they believe they have an extremely high credit score because they've been making their minimum monthly payments. And they find it a bit of a surprise, I have to say, when I explain to them that, well, if you've maxed out your credit, it can actually have a detrimental effect on your score. In addition, if they've gone into collections, those are negative effects on their credit. And again, it's going to be affecting their credit score. So what I'd like to do now is we're going to go over to break. But before we go to break, when we come back from break, what I'd like to focus in on is credit scores, where they rank. And then if your credit's been affected negatively because of some life events, how do we improve upon that? So we'll see you after the break.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
Summer days, summer nights, lots of things to do, places to go, and people to see. If you're having a few drinks, be sure to plan ahead and get home safely. We don't want to pick you up. Drinking drivers risk injuries to themselves and others and take chances with their license, their jobs, and their future. Remember what's at stake and choose your ride, whether you're the driver, the passenger, or the party host. Thanks for supporting Sober Driving. I hope we never meet.
Visit arrivealive.org to find out more.
Hello, everyone, and welcome back to Money Matters with Doug Jones. I'm Doug Jones, and joining me today is Julie Kuzmic, Director of Consumer Advocacy at Equifax Canada. And so before the break, we were talking about a credit score, a credit report, what goes into your credit report, what are the factors that's going to affect your credit score. So one of the things we didn't really delve into, Julie, was, we hear numbers. They're 300, 900, and a lot of people are really confused. I get people that come into my office and I say, well, have you ever checked your credit score? And they go, yeah, my credit score is 560. And I'm like, oh, okay, that's not particularly good, but they don't understand it. So maybe you could go into the scoring for us and explain what it means to a lender.
All right. So you did a little spoiler alert there by mentioning 300 and 900. So that's the bottom and top score. But we really don't see a lot of people at 900. So score, that's a huge range between 300 and 900.
Mm-hmm.
So a really great score is generally considered to be around 760, maybe 750, 760 or higher. And that's something that some people have trouble wrapping their head around because we're also used to thinking in terms of percentages as if we're being graded at school. And so we have some people who say, why is my score only a 780 out of 900? I've done everything right. And so the answer there is you're actually in the top category. So a bank typically wouldn't see any difference between someone who's a 780 and someone who's an 880, even though there are 100 points there. As I mentioned, the scores are viewed in ranges. So that's the highest range. The next range below that would probably be around 650 to 750, around there. That would be considered a good score. And then as you go lower, you get into a fair score, and then poor would be down at the lower end, like in your 550 and lower would be that would be a difficult score to get credit through one of the mainstream providers.
Right. And I think that one of the things that I've actually had people say to me is, okay, I'm supposed to have a good credit score, but the question becomes why? Maybe we should explain to people what a good credit score means for you and the advantages of it versus that sort of low credit score.
I love that question because we don't often stop to talk about why this is set up this way. Why do we even use a system like this? So come with me, if you will, on a short trip about 100 years ago. If you imagine going into a bank branch and applying for a loan of some kind, how would they evaluate that application? Well, in that time frame, there's a pretty good chance that they would decide whether or not to lend you the money based on whether they knew you or they knew your family or what your reputation was. And so the advent of credit scores and credit bureaus actually came about as a way of trying to level the playing field so that all individuals would get treated by the same criteria and it wouldn't be unfair as to whether it was an objective or subjective measure of the individual. So why scores? Scores are actually it's a pretty complicated statistical calculation that is referred to as a predictive analytic. And the intent of a score is to predict the likelihood that an individual will repay their bills, which is actually a reasonable thing for a lender to be concerned about if you think about it. If you go and ask somebody to borrow money, they want to have a reasonable idea that you're likely to pay it back. So that's where the risk component comes in, is how risky are you as an applicant for credit? How likely are you to repay your bills? So that's where the credit score comes in. But that's just one of many elements that lenders typically use to make those decisions. So anybody that's applied for a mortgage before has gone through the process of providing pay stubs and income tax statements and indications of holdings and bank account balances. There's a lot more that goes into that lending decision than just a credit score, because we talked about what's in that credit, about whether or not you own property or what your bank account balances are, or whether you have holdings, wealth holdings in some other institution. That information does not appear on your credit file and therefore is not part of the credit score calculation. So the credit score is just one piece of that overall decision on whether to actually approve somebody's application for credit.
Yeah, and I think the point that's important with that is that if you say you don't have the extra, you don't have wealth that's not reported, and you don't have a particularly great score, you mentioned earlier that in certain categories, you shouldn't have any problems with the conventional lenders. And so what I see is that people who have had some credit history problems, maybe haven't had credit for a long time, or the credit they have had has gone into collections and they've had maybe prior insolvency engagements. And so their credit's been harmed. And so what I think people need to understand is what the interest rate or the cost of borrowing to them is going to be if their credit score is poor, and the effect that why it's important to try to improve that. I've actually seen people with interest rate loans above 40% because of course they've had poor credit, and in order to access credit for a car loan or a short-term loan, some of the payday loan places now are offering installment loans, and they come at a very, very high interest rate. And so the point that I'm trying to get people to understand is that credit score is really important in order to get you more conventional lending and therefore more conventional costs of borrowing.
That's right. It sounds like maybe we should dive into what those people can do to improve their credit scores.
Yeah, so that would be the next thing I'd like to talk about is life events happen to everyone. I see it every day. People that have had problems, they had an illness and were unable to work, or they had a job loss and didn't replace their job with the same pay. And there are things that caused them to get behind on some of their bill payments. And so I call it their credit's been bruised. And so some people think, can I ever rebuild my credit? And so that's my first question is, can you address that concern of people's?
Yes, and I really want to start with this really important statement. Credit scores are not moral judgments, and they are not reflections of your character. So it's okay. If you're rebuilding for whatever reason, that is okay. And every day people are able to improve their credit standing. So don't be discouraged that you can never climb out. Here's one of the major reasons why. The government puts limits on how long negative information can stay on your credit file. And the reason for that is to protect us as consumers so that if we did have a rough patch, it doesn't follow us around for the rest of our lives. So even declaring bankruptcy, if it's the first time you've declared bankruptcy, that information is removed from the credit file after a period of between 6 and 7 years, depending on a few different circumstances, has passed. And all those other things, an item that has gone into collections, that will disappear from your credit file 6 years after that item first went into collections. So it won't stay on the credit file forever, which means it can't affect the credit scores forever. And as time passes and that item becomes older and older on the credit file, as long as you don't have new late payments being reported or new missed payments, if you're making all your payments on time, the fact that you had an item in collections will become less and less of an issue in your credit score calculations as that item becomes older, closer and closer to the 6-year mark, at which point it'll be removed altogether.
So what are the things that a person should do who's had their credit affected? They know that those things are going to age out, the prior problems. What are things they can do now to create some positives to help rebuild their credit score? And then again, corresponding with that is, I have people that think if they don't apply for any more credit, the other stuff will just disappear and things will be back to normal for them. And I'd like you to sort of address that as part of it.
So I mentioned that the biggest factor that affects credit scores is payment history. And that's because that turns out to be the most predictive element of all the data in a credit file of whether you're likely to pay your bills in the future is whether you've paid your bills in the past. So what the score is looking for in that credit score calculation is, have you had any late or missed payments? So if you find yourself in a situation where you cannot pay everything in full, of course, it's always better to make a payment in full on time. But let's say that you've got a credit card bill and you cannot make the full payment. It is better to make the minimum payment on time than to miss that due date and make the payment in full later. That's because that's what you signed up for when you got that credit card agreement, was that you would make the minimum payment by a certain date. So it's always better, as I said, to make the payment in full, also because utilization is another major factor in the credit score calculation. So if you're carrying a high balance, particularly relative to your credit limit, that is going to be working against you in the score calculation as well. So chipping away at those balances is going to help over time to improve your score too. I wouldn't recommend that somebody just stops using credit altogether, because you want to show an active, responsible use of credit over time. And we've actually seen it happen to people where they stopped using credit because maybe they got married and everything was in the spouse's name, and they are just using a supplemental credit card to the spouse's credit card, for example. Sometimes those supplemental credit cards will report to the secondary card holder's credit file, and sometimes they don't. It varies by card. So if that's the only credit that you're using, it may not be reporting to your credit file, in which case it looks like you're not using any credit. And so it happens over time that people become what we would call unscorable. Their credit file cannot be scored because there's no recent information on it. So how can we make a prediction of future behavior when we don't see any recent past behavior? So you want to make sure that you're demonstrating that ongoing responsible use of credit.
Thank you. That's great advice, and something I encourage people that after I've helped them through a financial difficulty, I am trying to get them back into using credit in conjunction, of course, with their financial plan so that they're able to repay. But I keep emphasizing the necessity of demonstrating to the creditors that repayment plan and that they're going to be on track. Another question that I got asked, and maybe you could address, is some people say, I've just went through a very, very messy matrimonial situation, and it's affected me for a short period of time, and it's going to affect my ability to repay. Can I tell the credit bureau that, and will it have any effect on my credit?
There is an element on a credit file called consumer narrative. There's a consumer statement, and you can call us up or send us a letter and write in a statement in your own words. Could be, I've recently gone through a divorce and this has affected my ability to pay. The part that we don't know is how that information is being used at the lender. A lot of the lenders are using automated systems to pull in the credit file data, so they may not be in a position to be able to evaluate that statement.
Well, Julie, we thank you extremely for coming on the show today and providing all this great information. It's the start of a new year, and people are planning their financial forecast for the year, and understanding how to improve their credit score is going to be a key component to them moving forward. And I'd like to thank the viewers for joining us again today, and encourage them that if you have any questions or comments about today's show or future things you'd like us to talk about, they can go to the show page at Rogers Berry TV and use the link there to leave us an email. Again, thanks very much. And I'm Doug Jones, and I'll see you next time.